My name is Sean Shepard. I'm the managing partner at U+. I'm also in the corporate venture building business, along with the team here that will be speaking to you about the 5 key components of successful corporate venture building. I'm proud to introduce Adrián, who will be introducing himself, and then the panel, and then this is going to be hopefully a very lively and interactive discussion. So I please encourage everyone to either come off mic and ask questions. It should be a fairly intimate group of about 20 to 25 people. Or if you prefer, you can use the chat. I'll be moderating and monitoring that and teeing up questions for the panel. Adrián, over to you.
Thank you, Sean, and hello everyone. Thanks for being here and joining us in this hopefully amazing session. My name is Adrián Heredia. I am CEO and founder of Build. We are a Spanish-based corporate venture builder. And obviously, as you already know what corporate venture building is, and we have quite little time, let's start with what's important. Today we have here with us Álvaro Portela. Please raise your hand, and Andrés Carrillo. We wanted to invite Álvaro from Vocento and Andrés from Serveo, ex-Ferrovial, as I really think they will bring very interesting topics for different reasons. Vocento, for example, has been, Álvaro will introduce himself, but Vocento, for example, has been building a new digital business for more than 10 years. And now Vocento, more than 25% of their EBITDA comes from this unit. However, nobody knows that because they decided to do it silently, avoiding what we know and what is called the innovation theater. Now they have decided to systematize this whole model to be able to scale it and build new ventures, but with a strong methodology, strong processes, and also with partners like us. Andrés from Serveo, previously they were called Ferrovial Services. He has a different story. He has been in charge of the new business department for many years, launching different businesses inside and outside Ferrovial, but he fell in love with one of them, and now he has become the founder of this business. So I believe this will bring a different perspective and an interesting perspective to the discussion. So yeah, that's it. As you can see, we have 2 different and interesting stories that I'm sure will give us a very interesting perspective on a few keys for corporate venture building to work. And that's it from my side. Let me introduce you to Álvaro and Andrés. Let them introduce themselves, and then we go back to the key topics, to the 5 questions. Right? Thank you, Andrés. Thank you, Álvaro. Which one of you want to start?
Do you want to start? Okay, yeah. Go ahead.
Let's go. Well, hello, everyone. I'm Álvaro. As Adrián was saying, I'm the Director of Marketing Alliances at Vocento. It's a media company here in Spain, specialized in regional newspapers, online and also in paper. And yes, we've been doing innovation or corporate venture building the last 10 years, building projects. And as Adrián was saying, we are a little bit of the ninja of innovation, of innovators, because we don't tend to communicate this. Even though we're a media company, we try to focus on the business and not the side of the innovation that a lot of people know and a lot of corporations try to externalize to, seem like the cool guys of the business, the cool innovators and stuff like that. We really focus on building businesses and trying to build EBITDA for the company in general. That's what we do.
Okay. And my name is Andrés Carrillo. I'm the CEO of Quico right now, which is a B2C marketplace for repairs and works. And as Adrián said, my story is quite different because I used to be the head of innovation and technology transfer of CVB, which previously was Ferrovial Services. But at the same time, I started to run and lead this project of Quico, and now we're in the process of divestment from the corporate and then developing that unique company. So it's been quite an adventure, and there are things that I can mention to you about how we have done it from the corporate perspective and how we are doing it from the startup perspective that probably are of your interest.
And some other things that you can't say because now they are in exactly the process of launching the new co officially, and Andres, he has his hands quite tight in some topics. Yeah, but let's start with the questions. We have 5 topics that, in our experience, in my opinion, are very, very difficult and important ones. Let's start with the easy ones, and let's continue with more complicated questions and more complicated discussions. The first one, just to understand what do you think about this, is the process from the ideation phase to finding the right entrepreneur and scaling the business. I mean, how do you usually start the process? What's the source of every opportunity that you launch? When do you incorporate the entrepreneur? What kind of methodology do you use during this process? When do you decide to launch the new co, officially the new co? What's your take on this, Álvaro?
Well, as a corporation, we usually don't build new cos. What we build is projects inside or in a corporation already existing. So what we usually do in the process of building these projects is we try to discover which areas of the company are key and are able to help us build this new project in that area of interest of us. So, for example, we, as a media company, we have different verticals. We have gastronomy, we have automotion, we have real estate, we have media companies, of course. So we have a bunch of different sectors that we can, try to learn from them, discover things on those verticals, and try to find interesting projects that are not usually the core of the business, but there are nice to have on that vertical, and we start from there. Once we have identified those possibilities or those projects that could be interesting in each sector, we tend to try to build from little things to start trying if some of them could work in a big scale. So we try to build small things with little costs, and what we do is we have a kickoff meeting where we try to get the KPIs that are key to the success of that business, and with those hypotheses or those tests, we try to get to those KPIs. Once we get to one of those KPIs, we focus on that project and we start, building the plan for it, building or thinking about how the team will be structured, and doing a bit more tests. Once that is ongoing, we have the advantage of that because we are a media company and we have different regional media companies, so we can try a project in only one media company, for example, regional media company. That's a small test. If that works, then we scale it to the whole company with all the regional newspapers that we have there at 17 here in Spain. So basically what we do is each step that we do of the process from discovering what needs the different units of the company had, doing the hypothesis, trying with a small test, trying to get to those KPIs. We try to do it in small batches. And then once we get to those KPIs and we build the building plan, the business plan, what we do is start trying to find the team that it's going to, operate that business. Usually we start finding these people or these key people inside the company, because we believe that a very important part of this is understanding the business, understanding the company. Our company is, for Spain, is a very big corporation, and it's very political. So there's a lot of, bureaucracy, and there's a lot of knowing the right person. So it's important if they know how the company operates. So we start there. And then if we don't find anyone there, because maybe the business is, you need to have a very deep know-how of that part of the business, and it's not core for us. So there's no one here that understand that. We try to, reach through our contacts, go outside the box and go to, startups maybe that are working in projects that are very similar to this. We try to, maybe try to bring the key people inside, or if we cannot, usually with the startups, what we do is try to invest in those startups, bring in, try to merge that startup with a project that it's an ongoing, and so on.
Okay, perfect. Thank you. And you, Andrés?
Yeah, I mean, I quite agree with many of the things that Álvaro mentioned, because so starting from the last part of that Álvaro said, like how, I mean, better to say, when do you introduce the entrepreneur within the project? So if you asked me that question like 2 years ago, I would have said just at the very, 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 very beginning, because in everyone's mind is like, okay, you have to put this person in order for him or she to lead the project from the beginning. But in my case, and it's working, I wasn't at the very, very early beginning of the project. I was on an early stage, but not at the very beginning. And that is, I think that's the best. And we have to balance that, because when I arrived into the project, I was more open-minded, and I have a fresh mind in order to change some things that when the MVP was built, needed to be changed. So I think that you, in order for balance that and get a new view of what things can be changed and what things can be better and improve, the right balance is you have to put those people in the project at an early stage, but not very, very, very early on it. Because if not, sometimes if it's your boy, that you are building from the scratch, then sometimes you cannot analyze the mistakes that you can make, and that is quite a thing that you have to take into consideration. And I totally agree with Álvaro that one of the things that this person has to have is that it has to have really good social skills in order to navigate on the corporate oceans, because that bureaucracy and politics that you have in a corporate are things that if you are not good handling them, then you drown yourself, and then you cannot move on the project. But more than that, what I believe is the most characteristic thing that you have to take into account is that person has to be a truly believer of the project. Because if he or she is not convinced himself from the project, then it can convince the rest. So being a truly believer of the project and really believe in the idea of that project going ahead is quite a thing that you have to consider. And once said that, is more about the when do you think is the best way to introduce or to put the entrepreneur within the startup. Coming back to the other part of how we build it, in our case, all the new ventures that we start are started within the business development area, and some companies prefer to do it on the operation side or just on the business lines, but we prefer to do it on the business development area, because in this area we have specialist teams like innovation or strategic projects or others like that, and you have a broader knowledge of the company and what is the strategy that the company wants to have, and our ventures are always aligned with our strategic plans. So it's quite important for us to have at the beginning that project within that business development area, and then when it's mature, then pass it to operations.
Okay, thank you, Andres. I completely agree with you both, and disagree on some ones, but we don't have time. Let's continue with. We usually talk about validation, but what's the right level of validation for you? I mean, how many times does an idea to be validated until you really decide to create the company? This obviously means incorporating the entrepreneur, incorporate the company if so. Obviously, really design and approve a business plan. The thing here, or the thinking, the reflection here is obviously a corporate does not like risk, and the normal tendency is going to be to reduce the assumption, reduce the risk as much as possible. However, you all know that when launching a new venture and a startup, risk and uncertainty are obviously part of the business. The question here is, in your opinion, what's the sweet spot between reducing the risk before launching the venture, but leaving part of the fun to the venture itself? When's the right sweet spot for you? And obviously, there is not a right answer, but what's your take on this? And please make it briefly, because we don't have so much time.
Yeah. So in my case, I think that so time constraint is the worst enemy for a startup. So if you are thinking on that the time that you have now it's limited, then you can't create a new venture completely well, because you are always thinking on the time and you do things with more risk and everything. So that is one thing that we have to consider. There is no right spot, but in my opinion, the project should be validated as many times as it needs in order to just go into one thing that at least has a strong strategy and a well-balanced goal objectives for the team and for everyone. So you can manage the expectations of the company or the boards that are with you investing in the project.
In our case, I think it's a little bit different. A corporation is not a fund. It's not we invest in X number of companies to try to get one hot shot and then that can cover for the rest of the losses. It's a bit different because the balance is the same for the ongoing business that the company has, the core business, and also the investment, the capex that you do in this small projects. So for us, it's a data-driven decision. You need to take the time to really understand the business and mark the right KPIs, and that's what's going to drive all the phases that you're going to go through, from discovery phases to the building a new core, a new project inside the company. So it's basically data driven for the KPIs.
Yeah, I know. Well, and it's quite a different question, but I think it's related. What's the perfect equity mix when building the venture? I mean, obviously, before discussing this, we should begin by asking ourselves what kind of venture we are building, and And I think the question here is this a spin-in venture or a spin-out venture? Obviously, for spin-in ventures, I mean companies that are built outside or around the company, but we obviously know that the end goal is for the mother company to reacquire control after years. And spin-outs, a company that completely exits the corporate universe. In my opinion, for spin-in ventures, we usually recommend the corporation to assure control because, at the end of the day, the final goal is for the corporate to take control of the company. And this will influence on, obviously, the cap table and the kind of equity, the kind of entrepreneur, blah, blah, blah. But for spin-outs, it's also critical to assure that the cap table remains sexy for future and external shareholders. Obviously, it's impossible to raise money from VCs if the entrepreneurs owns 3% of the shares of the company. What's your experience and what do you think about this reflection?
Well, in my opinion, sometimes the problem is that you don't know if it's going to be a spin-in or a spin-out. And that is the point. So in order to ensure that you have two possibilities within that new venture, the best way is to build in a corporate area, like for example, the business development area that we have. So if we build it there, we buy some time and we take the decision later of a spinning in or a spinning out. So taking it to the business or to an operations area of the company or the spinning out. In terms of a spinning out, it depends on what is going to be your partner. But if it's another company or another corporate like the one that you are in, what you have to focus is on what are the needs of that other company that is going to partnership with you, and then find that sweet spot of who is the one that wants to take the leadership. There can be situations like the one I'm confronting right now, is that both partners are going to have 50-50%. So the problem there is that you have to be all the time in the middle, but it's a really nice situation when everyone is fully aligned. And in order to make that, is what you have to do is develop a really strong business case, ensuring that the strategy is quite well aligned for both companies, and then going ahead.
For us, maybe it's easier because we usually tend to do spin-ins. As a corporation, as I was saying before, we don't really usually build newco. So it might be the last phase of the project might be building a unit per the project or trying to fit that project into an existing unit. So all of those are spin-ins. We have 100% of the business, and that's it. But there are some cases that the business that we are building might be scalable outside of our reach. Like, for example, we are a media company in Spain. Our reach is Spain, our regional reach, right? But if we see companies like we've had before, like, for example, Geld, that it was a data company, cashback/data company. And we see that this could be potentially a product that we can scale in Europe or in the United States or LATAM or whatever. Then we try to find early in the process a partner that could help us bring more capital, bring more knowledge of the business, or even partnering with businesses that are going to be closer to that business than we are, in terms of scaling the business outside of our reach, that it's Spain in this case.
Yeah, I always say that the cap table is not something static that can't change. It should change, considering the moment that the venture is living at the moment. And one related question is, you have mentioned that the understanding of the corporate strategy and needs by, in this case, the venture builder. In your cases, you said that the source of the opportunity comes from the business, but many corporate venture builders tend to build things that are not really related to the corporate strategy. This means they don't really understand what's deeply the corporate strategy. They basically conduct a quick or a deep market research and put their efforts into identifying, big trends, hot topics, and models that are replicable. And obviously, as a result, the new venture is something interesting for the market, but not sexy to the corporate strategy. And we have exactly the opposite, which basically are consultants that ask the corporate what the corporate wants and basically execute it. And this is something that you at the end decide that you want to spin out and reach for external stakeholders, you are going to have a problem because it's something sexy for you as a corporate, but not sexy, not really sexy to the market. What do you think?
Well, it's a good question. So, for example, we as a media company, we have an easier path for innovation than companies that are vertical. Like, for example, if you take, I don't know, an oil company. An oil company is not going to release a marketplace for mattresses because it doesn't make any sense. For us, we have a wide range of projects that we can release because it's just because we have audiences, and audiences are interested in X, Y, Z things. So tomorrow I can release a marketplace for mattresses. The day after tomorrow, I can launch B2B digitalization services for small and medium enterprises or whatever. Because my core business is audiences, is people, right? And interests that the people have. So the question that you're asking, it's very, very difficult to answer for us because we're navigating in the middle of what should we launch, something that is very, very close to our strategy, very core, or something that is crazy and potentially be a scalable business because the market is what the market wants. Right? So I think it's in the mix where the sweet spot is. Like, we launch things that might not be our core business, that it's advertising, but we launch businesses that we think our audiences will like. So we can help in the beginning of the process of launching that business because of the big audiences that we have, and it's easier for us than a startup with 3 guys in a garage trying to launch that because we have that initial push. But we can launch crazy things sometimes and try to convert that in spin out, for example, or make it more appealable for the market.
Yeah. You are talking basically about assets and fair and unfair advantages from the corporate side, which is the next question. Andrés, what's your take? And we go to the next question quickly.
Well, I will be very briefly. So in our case, every venture that we build is quite related somehow to the expertise of the company. So it's related to maintenance or FM or things like that. It depends on how different it's from the day-to-day operations that finally is a spin-in or a spin-out. For example, a spin-in the previous years was developing a new business unit for electric charge maintenance, or developing the business line of bike sharing that we have now in Barcelona and Madrid, for example. So those can be a spin-in. But for example, on the other hand, we have my case, which is Quico, and it was a spin-out because what we found is that Serveo has a lot of knowledge of FM, has quite a broad fingerprint on the FM market, on the public sector and with big companies, but it's too big and too slow in order to attack the B2C market. And that is why another way of doing things was needed. So we know how to do things, we know how to do repairs, we know how to do works, but we know how to do the FM. But the thing is that we need some vehicle which is more agile in order to go into that market that otherwise Serveo couldn't reach it. So that's why we built a new vehicle and then we launched it quicker.
Yeah, this question is very related to, and you have said it. This question is very related to the next one, because when we are talking about corporate venture building, I believe we are talking about two pillars. One of them is strategy, and where do we find the opportunity in terms of the growth strategy or the diversifying strategy, and the other one is what kind of assets am I leveraging into the new venture? And let me elaborate this. For us, we have 6 kind of assets. One of them, obviously, you guys have. You as a corporate have. You have money. You have clients and distribution. You have obviously know-how. You also have sometimes tech or intellectual property. You have brand and credibility, and you also have know-how, which is very, very needed sometimes. In our opinion, money is necessary, but it's not enough. Obviously, money is just a corporate venture capital investing in one startup. For us to call it a corporate venture, we need to assure money plus any of those assets. Okay, what's your experience on this? I believe that obviously your model, Álvaro, is more driven into the clients and distribution asset because it's what you really have, and this allows you to start projects, multi-corporate venture building projects, right? Because you put the audience and then another one put the know-how or the tech or whatever. What's your experience on this? What does it mean for you when it's not only financial contribution from the corporate side? How do you value that contribution? What do you think?
Well, I think money, it's clearly not an advantage that a corporation has, because there's a lot of money in the market for investment in startups, in good startups, or in good projects. And yes, as you said, clients and distribution for us, it's key. Obviously, clients and distribution, for example, when we invest in a startup, a typical investment in startups in the media sector is media for equity, right? And usually startups don't like that because it's very difficult for them to value the media. And it's usually very difficult for us finding startups that are in the exact moment, the sweet spot of growth, where the media that we can give them, it will be usable. So, for example, yes, I have a lot of reach and I can put banners everywhere, content everywhere, whatever. But if you're in a phase where you're trying to test your product, all is going to go to waste. So to find a company that it's in the right spot where our media is going to help them, it's very difficult, and but if you find it, it is very, very easy to give it value, right? Because you have, again, going back of what I said before, you have all the data. I have all the impressions, clicks, the CTRs, the clients that I get to you, that I got you. So I have all the funnel, so I can value at the end of the campaign, for example, how much my media it's gonna give me equity in your company, and the same for a project. What's the number that I'm going to put in the business plan for that media? In our case, because we have a lot of experiences launching projects inside the corporation, we know how the funnel is going to be more or less, so we can give it a value for that clients and distribution, that is basically media and distribution. So for us, it's easy because we've been doing it a lot of time.
In our case, it's quite different because if we don't have the money, it's usually quite difficult in order to develop a new thing within the company, because okay, you can have some resources and everything, but there's a point where you need someone fully dedicated or some external for you to help that push, and if we don't have that money internally, sometimes even if we have a good project, it can be a go no go. But what we have found is that in order to fight this lack, the point of view that we follow is we check what are the needs that we have within our business, and then we try to check for something that fully solve that problem. So somehow you can pass some money from that operational business to your new venture, and then grow from there and just start, because if not, the beginnings are quite hard, and if you don't have money, it's quite difficult. Even that all the things that a corporate gives you apart from the money are totally necessary, and for example, brand and credibility is for me one of the key things that a corporate can give you.
Yeah, one thing that I believe, because I know your model, I think that it's interesting for you to explain to the audience is you guys really like to find other partners.
Yep.
You really like to identify the key drivers for this business and the key partners in order to start this business, and then you incorporate those partners into the cap table, which is basically what you do with Quico, right?
Yeah. So basically, and that comes quite related with the thing of the money. So if we would have a lot of money, probably we would do it by ourselves. But as we don't have infinite money, we have to check for some money with some partner. But at the same time, we don't like to ask for just money, because it's not our way of doing things. So we find a partner that, apart from putting money into the new venture, give us some need in order to, we solve a need that they have in order for us to get the break even earlier. So if we secure some of the business or the operations with that partner, then we can just grow faster, and we just don't have the money. We have the money, and we have someone that has a very good strategy, fully related with us, and we are fully aligned in order to grow. So that happened with us, for example, with City, with the car sharing of Madrid, when Ferrovial Service at that time partnered with Renault, and now in Quico we have been dealing with a partner that it will be probably in the media in the next couple of weeks. So we are now partnering with someone in order to grow with Quico and make it more strong than what it is now.
Adrián, we're coming up. We've got about 5 minutes left. So would it be a good time to open it up to the audience for anybody to ask questions?
Yeah, sure.
So if anyone has a question, feel free to come off of mute and just speak up or put something in the chat. While we're waiting, Adrián, I have one question about the equity mix. We run into this challenge a lot with our clients. What have you seen work when someone decides to spin out a new venture in terms of the cap table and or the equity mix? Is there a standard or a best practice that you've seen be more successful than others to make a cap table and investments attractive to an institutional investor?
Let me start with the answer, and then I will pass to Andrés and Álvaro. In my experience, obviously, it's very difficult to decide if a venture is a spin-in venture or a spin-out venture at the very beginning. That's why I said that you need to be able to iterate the cap table during the life of the venture. But even though it's difficult, you need to ask yourself from the very beginning to be aligned with the expectations that you as a corporate venture builder have. Obviously, also the expectations for the corporate, but most importantly, the expectations of the people that you are involving in the venture. And I'm talking about the team and obviously the founder. It's going to be very difficult for you to attract a very serial entrepreneur, with many battles over his or her shoulders to a new venture that, which real plan is to be a spinning and giving them obviously 5% of the company. This is just, in my opinion, a mercenary. And it's going to be very difficult for you. I don't align with that model. The rocket internet model with and in these cases you have many tools in your table just to be able to modify this cap table. For example, for us, it's critical to offer an option to the corporate to acquire control to the company, but this offer, the value of this offer is higher as the time passes. This put some pressure on the corporate just to decide if they see the company as a spin-in or a spin-out company. This is basically the take control phase. You have some time left, but you don't have infinite time to decide this.
If you do decide to spin one out, is there a standard structure that you suggest, recommend, or have seen in terms of the equity mix of ownership between the founding team and the corporation? And how much is left for investors? Have you seen anything there that works?
In my experience, it depends on when do you decide it. Obviously, if you decided, if you see a spin-out venture since the beginning, this means you need to raise money from investors. And it's going to be very difficult for you to raise money if the corporate owns 70% of the company, the venture building 20% of the company, and the entrepreneur just 10%. Right. But if you decide to spin out the company, in year 4, when the company already has, EBITDA or whatever, the thing is big. Your investor is going to be an institutional investor, maybe private equity, and this kind of stakeholders are really aligned with, the entrepreneur having 5-10%, because otherwise, in the normal history, the entrepreneur is going to be diluted in that moment of time. So, in my opinion, depends on when do you decide this.
Sure. Okay. That's very helpful. Thank you. We have 1 minute remaining. There is another session coming up after this that's been posted in the chat that Betty wanted to share. I want to thank the panel for a lively discussion on corporate venture building. I find the equity mix personally to be very fascinating. Still trying to figure out what works. I've seen everything. And if you have everything, you don't really have something that's repeatable. So that's why I brought the basis of my question. But I want to thank you, Adrián, Álvaro, the whole team. I appreciate it. Andrés, thank you so much for a lively and insightful discussion from your perspective. Betty, back to you.
Thank you, everyone.
Thank you, everyone, for coming. And we'll see you in 15 minutes if you join the next one. But thank you, Adrián, Andrés, Álvaro, AAA, and Sean, also for being here. Thank you, everyone.
Thank you, everyone.
Thank you. Bye. Have a good day. Bye-bye.
Bye.